Obviously, we're heading into a significant economic downturn. There's been a significant slowdown in M&A. Is there a rebound before the end of the year, or is that a long ways off?
Look, I think I'll be very balanced about the M&A market. Just to level set and give you a perspective on last year versus this year. Obviously, last year was extraordinary. Year to date last year, we saw about $4 trillion of activity overall in the M&A market. This year, it's about $3 trillion. So think about kind of 30–40% down from a dollar volume, but also from a transaction level. But many of the foundational pieces that drove the M&A market remain very much intact. You think about equity capital looking for opportunities. You think about private equity. You think about corporations looking to position themselves strategically for the long term, something that we saw very, very strongly last year coming out of COVID. So there's certainly reasons to think about drivers of strategic and corporate and private equity M&A activity. That being said, you certainly need to be balanced and need to be guarded that we're looking at a year that is pretty close to the 5-year averages, maybe a little bit above. And 2021 obviously was just an exceptional year.
But Stephan, let me pick up on that. If the drivers are still there, and yet, as you say, we're going to be down probably at least 30–40%, I guess the obvious question that raises is like, well, then what's slowing it? Is this just interest rates? Is this just the fact that we're late cycle, or is there something else going on there?
Look, I think there's a lot of things. I think it's late cycle. I think there's global volatility and instability that we see every day. M&A is driven by CEO confidence. That is the #1 driver. And there's certainly a lot of things in the market, whether it's interest rate increases, inflation, again, global instability, that have caused people just to slow down a bit. It doesn't mean that the backlog, for instance, of private equity portfolio companies that want to be sold is any different. I think it's a question of when, and when would those come to market.
But that's a shift, because the CEO confidence point I agree with, but they've been able to see through a lot of this volatility before. They were able to see through COVID, after all, and all of the sort of uncertainty that came out of that. So what is it now that's going on that's made CEOs say, okay, we're not going to pull the trigger, we're not going to do those big deals? Because that, particularly in the market, we have seen a real slowdown, the sort of the big mega cap deals, if you like, that imply that higher risk appetite.
Yeah, there's actually been a tremendous number of very large transactions this year. But if you're a CEO, again, I mentioned and talked about the CEO confidence issue, you're still looking, you're still talking, you're still discussing with your board the timeline to executing, the timeline from execution to closing. Those have extended and become more complicated. And so you're seeing a bit of a pause, as we just talked about. But again, back to those fundamental drivers, the dialogue is still there. In fact, if we look at the new mandate checks that come into Goldman Sachs, those are running at levels very consistent with the beginning of this year, and certainly at various periods running consistent with what we saw in 2021.
So we're looking at a very good end to the year?
I'm curious.
We certainly could be, and I think it's more a question of when. Obviously, the interest rate raises have a quelling effect. And so I can't sit here and say that's going to be fourth quarter, that's going to be first quarter next year. But again, a lot of those drivers remain in place, and I think it's a question of when, not if. But we're certainly seeing balance and a bit of caution in CEOs and executives right now.
Stephan, I'm curious if you're seeing much buyer's remorse, because yes, we saw handshakes on some big deals at the end of last year, at the beginning of this year. Thinking about Twitter and Elon Musk, and now him trying to get out of that deal. He says it's because of bots. There's also some speculation from Twitter's side that it's because the market and the conditions have changed. What do you think?
So, Goldman Sachs advised on Twitter, certainly wouldn't comment on the Twitter situation, but in general, we have seen institutional investors and boards applauding their management teams from doing strategic transactions and looking to put in place the strategic foundations, not for the next year, but for the next 5, 10, 15, 20, 30 years. And institutional investors have very much supported that. So we have not seen, certainly have not seen widespread buyer's remorse for any of the large transactions that have been announced in the last several years. And in fact, we've seen institutional investors continuing to encourage their management teams and their boards to seek out strategic opportunities.
Stephan, talk to us a little bit about the regulatory environment. We know under this administration there is a toughened stance as it relates to sort of traditional antitrust, but particularly around big tech. And I wonder what your clients are saying to you about that, what it's done to their appetite, and indeed what advice you can give them in terms of pulling the trigger on some of these bigger, more complex deals.
Sure. Look, regulatory has been a factor in every administration for many, many decades. It's one of many factors that we spend a lot of time with our clients and with boards on. But again, it's one of many factors. And there certainly has been very substantial large tech activity, as you have seen. And so it's not stopping management teams. It's not stopping tech boards from thinking about what is the right strategic positioning. Is it relevant and certainly very important, and we spend a lot of time talking about it? Sure, absolutely. But that's not different than past years or past administrations in terms of how you think about regulatory being one of many factors that you consider in a transaction.
One of the opportunities that seems fairly obvious for buyers at the moment is the foreign exchange arbitrage, if you like. If I'm a US corporate sitting here looking at my opportunities, how attractive is Europe and the UK right now?
Well, certainly currency has moved dramatically, as we have all seen. What I would say is, cross-border has been one of the areas that's been less active. So certainly currency could help that, but it's, again, one of many issues. And so, COVID was certainly a big quell on people meeting face-to-face, which is an important part of doing deals around the world. And you really haven't seen a big pickup or a resurgence in cross-border. And I wouldn't say that currency has really caused that to change dramatically. But certainly it's been certainly for global companies, it has a huge impact on their earnings, and they all focus on it, but I haven't seen it being a big factor in cross-border M&A.
Stephan, I wonder if you think that could change, especially going into next year if the dollar remains strong, and where you do see in what sectors, whether it's cybersecurity or social media or artificial intelligence, where you think that M&A could pick it up if and when it does.
Look, I think technology is pervasive. It's not just tech-to-tech mergers. It's industrial technology. It's consumer technology. Technology is pervasive in healthcare. And so when you think about transaction activity and technology specifically picking up or becoming more active, it's going to affect every industry. When you think about the most active industries now, certainly healthcare, certainly technology, certainly industrials, but it's mainly, and big parts of it, are the technology components of those industries. So I certainly expect that to remain strong, but I think you got to look much broader than just core technology when you think about technology's impact on the M&A market.